All right, let's take our conversation forward. Venugopal Garre joins us from Bernstein. Let's understand what his prognosis and market view 2024 is. Venugopal, good morning. Thank you for joining us. We've had a good 2023. How much of the 2023 good market, good momentum will spill over to 2024 as well? Are we in for another year of positive returns?
Thanks a lot for having me on the show. Yes, last year was exceptional, and I would just remind all the viewers as well that I think beginning of last year there was a lot of uncertainty, right? And I don't think this call for last year as well was something which was conceived at the beginning of last year. In fact, we ourselves upgraded India only the fag end of March and early April to a buy. Now the reality is that given the fact that we are sitting with a lot of gains last year, and more importantly, as I see, a lot of the base support, especially for the economy, to a large extent is behind earnings revisions, which were actually pretty good in this last 6 months of the calendar year, has also led to a situation where EPS revision momentum is more or less moderate now. So we are like more or less looking at a peaking of EPS momentum, though even though EPS growth is still very decent. So putting this into picture and the fact that a lot of the surprise positives in terms of a rate cut possibility this year, which was not thought of in the first half of last year, as well as a much better political stability outcome, which again was something which was iffy in the beginning of last year. All that is also known and sort of digested in the market, especially in the November-December rally. So I think the return expectations have to be a bit more modest this year from equities. And unless we see any further sudden surprises coming in later in the year. So that's how we're starting the year with 8% Nifty return expectation for this year. We're essentially saying that book profits right now wherever you can, because it could be a range bound in a volatile market, especially in the sort of a near term. Not really changing a 3-year or a long-term outlook where we're still extremely bullish on India from a long-term perspective.
Hi, morning firstly. So just wanted to understand that given, there is, the valuations are not cheap in the market right now, are there any bottom-up ideas available out there? And should that be the theme that one should be scouting for new ideas?
Yes. Historically, to some extent, when it comes to individual stock picks, we usually have tended to avoid just taking valuation calls. Fundamentally, we've always looked at the construct of earnings growth, sustenance, momentum of earnings, the secularity of business and management. So a lot of host of factors. By the way, this year is going to be a bottom-up year to a large extent, where you have to be very careful about stock picks. So the way I would approach it is, especially a lot of these large caps look fairly okay from a growth sense as well, and perhaps may not necessarily have rallied as hard last year for a host of factors, given that you have a lot of alternate options as well. So if you look at the India portfolio that we have assembled, in fact, everything is large cap at this juncture. So I'll just mention a few because there's a published sort of a report. Financial sector to us looks fairly attractive. So HDFC and Axis are there in the portfolio. We have Infosys and IT, the only representation at this juncture because it's been an underperformer and laggard as well. Cipla in healthcare, which is an overweight sector for us. Reliance has been a pretty big laggard last year, so that's another one. We upgraded telecom to an overweight, so Bharti is another large cap. NTPC has rallied hard, but still eking out some return possibility this year because the sector looks okay. L&T is another one where, despite having run up and being rich on valuations, we're still sort of keeping it from a growth and a cycle sense. So these are the broad stocks, to a large extent. Even Adani Ports is something we added in the Adani stock for the first time in India portfolio. So these are the ones which I think from a large cap sense look fairly okay from a growth perspective.
I just wanted to touch upon one of the long-term compounding themes, and with a spotlight on digitization, given that we've seen ever so much progress taking place and so much more to come, how are you looking to really play this theme? Because it really seems to be very divided, even when it comes to the view of AI on IT, that it could be more of a bane before it actually becomes a boon for at least the traditional IT players.
That is right. See, digitization is a pretty large underlying theme. The ways to play it is going to be spread across. I've always mentioned that digitization is something which would be an existing corporate primarily, sort of digitizing. They also get benefit out of it. It could be using digital channels to sort of sell products, or it could be primarily about their own entire data architecture and the things they're trying to make themselves more efficient by digitizing internally. So host of ways of doing it. So, or you primarily play individual companies which are direct consumer tech plays, which are the sort of representations of digitization, which could be in financial sector, which could be in retail sector. So there are a host of ways to play it. Now, at this juncture, I would probably say it's very early because a lot of things are developing. A lot of new companies will list, and probably you will have much better direct and larger options to play digitization. Consumer tech as a space is something that we like over the long term. Look, we downgraded it heading into this year. This is something we discussed in our previous interaction as well as now in November, that I'm thinking about shifting to IT services within tech. So we've actually done that. We're more or less neutral in consumer tech at this juncture. But that's not a bad way to play long term. The only area within consumer tech which is a bit scary for me, and I'm having burned fingers there, essentially is a fintech part of the things where the regulatory clarity is still very tricky at this stage. So that's something that we need to see how that evolves. But that's one way of playing it. IT services will be a beneficiary medium to long term as they are the implementers in any case. But that's a secular growth sort of a sector. I don't really think any of these digitization initiatives are going to lead to a major change in their long-term growth trajectory. It is all about them coming out of this low growth trajectory and moving into the normal trend line average growth over the long term that I guess they should be able to do, which is where there is some value out there.
Venu, just going back to the list that you
Yeah.
were earlier highlighting, I mean, Reliance, Bharti, L&T, it's clearly back to the large caps, right? Does that mean you're looking at phasing out from the mid and the small caps?
Look, I think mid and small caps are excellent spaces over long term. And a lot of multi-baggers come from there. And I've been fortunate enough to have identified quite a few of them over the last 25 years. But the reality is at this juncture, I have moved to an underweight on SMID relative to large cap. Now, I had this 20% allocation in the India portfolio to SMIDs, which I have actually made it zero right now. It does not mean I would completely avoid every SMID company or every small and mid cap. There will always be bottom-up opportunities that I would be sort of evaluating and investing. So that's the call at this juncture. And in any case, Nifty was expecting high single-digit return, which is not the case with SMID overall. So that's where I am at this juncture in terms of how I'm assembling. I'm primarily, hence my entire India portfolio is assembled around large caps at this juncture. So look, it's going to change over time. So it's not like something cast in stone. We change it every quarter. We'll see how things pan by and review it a quarter later.
Fair point. But your call to go overweight on IT, and IT, with the exception of Infosys, 2023 was not a bad year for IT. In fact, the IT index did give a return of 24-25%, which was actually higher than the Nifty. So what makes you bullish on IT? Cycle is not great. Valuations are above the historical average.
See, if I were to look at last year, to a large extent, the heavy lifting of returns were done by SMID in IT services. And I was in some way down the line playing that through my SMID allocation. But I was not really directly playing the large cap IT, which to some extent has lagged quite materially last year. The second thing is, within the large cap IT space, the idea simply was that if I'm talking about an IT services earnings momentum bottoming out, you're going to get some negative information even in this particular quarter numbers. But then at the margin, looking at the earnings growth, estimates of consensus that look more or less realistic. Now, the reality, since I'm anyways not negative on the sector long term, I felt that perhaps this is the time to start pushing that sector from a large cap sense. And that's a reason why we decided to have the overweight within IT allocated to IT services. It's not a very large overweight, our largest overweight position in financials. So it's a marginal overweight on where the index weights are. And hence, in the India portfolio, we have one large cap, which features out there as the way to play that, because that has been the biggest laggard in any case, trending closer to average valuations historically.
One call which everybody will have to take now, whether it is the election cycle or whether it is valuations or the recent run-up, is that how do you approach government companies? Especially the ones which are dependent on government for orders, railways, defense, infra. How would you approach that space?
Yeah, so I mean, look, there has been this sort of a theme underlying in the market around public sector companies being the ones one should select. And the reasons are very simple. They were relatively cheaper valuations wise and they were getting their growth. This is across the board. We look at financial sector PSUs to the capex side of things. See, one of the key underlying factors, especially since you mentioned about the capital expenditure linked ones, be it defense or infrastructure, they had this major advantage over the last 2 to 3 years because we were going through a pretty strong government capex cycle. So if you were to look at government's allocation to capex within the central sector budgets and the special allocations they did to the state, they had the flexibility of doing that for two reasons. One, we managed to get a much larger tax collection than expected, especially on indirect taxes. That tax buoyancy basically helped. Number two, we had the flexibility of keeping higher fiscal deficits. I mean, look, if you think about it, that 6-ish% fiscal deficit, 5.86 accounting adjustments wise, it's actually more than 6. This financial year, which is getting over, I don't think we would have been allowed to have such higher fiscal deficits in the pre-COVID era. Right? The fact that we managed to keep in plus 3.5% for states, this is a unique situation. Now, over a period of time, we will bring that down because it could. You have to, of course, align it with how things happen globally, especially risks around inflation and things like that. It's not a perpetual fiscal deficit number. So as you bring it down, your government capex will also sort of moderate and shift towards private capex. So what you're playing right now from a sense of PSU infrastructure is good. I mean, it's still good for a while, especially for the next maybe 12 months. But you will have to start looking at more proactively potential opportunities in private sector and whether these PSUs can actually tap that or not. Quite a few of them cannot. So that's the way this is a transition phase right now for them because a mix of capex will change over time.
Venu, great to have you on the show. Thanks for taking the time out. Always good to listen into your thoughts on the markets.
Thanks.